Yes.
How you doing? It's just me and you so far.
Okay.
Where's Ruby? We we can't. Doesn't seem the same without Ruby or Natalie, huh? Did you watch the New York Jets this weekend? No.
No, I did not.
Guess what? They lost again. No surprise. Okay, I'm gonna have to trim out the first part of this discussion, or my boss will
Okay.
jump all over me again for goofing off. Okay, I'll assume it's just gonna be us then. You ready to do a little work together?
Yes.
Is there any before we start? Is there anything you want to talk about in terms of questions or anything that's bothering you in terms of the material?
Um, no, I don't think so. Not that I can think of right now.
Okay, because you're doing very well on the tests and everything. Looking at the homework last night.
Yeah.
Okay, all right. Let's go into closing entries then. Okay,
Okay.
Clo- closing entries, and this is chapter 6. Where is chapter 6? Can you see the PowerPoint now?
Yes, I can.
Okay. All right. Chapter 6, closing process. At the end of each month, at the end of every fiscal period, if you make a profit, that increases the equity of the business, right?
Mhm.
Remember, we do the income statement first because we want to find out the net profit. And then we're going to take that net profit and add it to retained earnings, which is part of equity. The closing process is the journal entry to record that transfer of the net income into retained earnings. And what we're going to do is we're going to zero out our income statement. So let's get going here. Okay, they talk a little bit about the worksheet. Um, and I'm not sure how much we need to go deep in this, but the month ends, right, Riley? And you prepare a trial balance. And we know a trial balance is just the listing of the accounts to prove that debits equal credits. And we also know now from chapter 5, we have to prepare adjusting journal entries. And then when we've prepared those entries, we can start doing the financial statements and close. So they're going to present to us a worksheet here, a worksheet. And they're reminding us that the order of the financial statements, income statement, equity, balance sheet. And they're giving us some tips, huh? Company name on top. Period ended. Remember, this is the one that is the one that says month of.
Mhm.
We know these things. So let's take a quick look at the worksheet here. You can see this. You can read these words here. You can read this stuff.
Yes.
Okay, I'm glad you can. Okay, remember our trial balance is always going to be in order of assets, liabilities, equity, revenues, and expenses, right? So I've told you guys find your first revenue account, and here they just have one, delivery fees, and deliver everything above delivery fees is your balance sheet, and everything delivery fees and below is your income statement. Okay, so that's a good tip to know. And with that in mind, we can now take this trial balance and turn it into our income statement. So that's not too tough, O'Reilly. You're just
Mhm.
going to prepare an income statement. You're going to your adjusted final trial balance, and copying these numbers into your template. Any questions with that?
No.
Not too bad, huh?
Nope.
Okay, so we continue here. So now we did the income statement. Now it's time for the equity statement. And that's the one where we have to bide our time. BIDE, beginning balance, beginning plus income or investments, and then any drawings, withdrawals. So here we go. This business started off with 0. He invested 5,000. They're giving you a subtotal. And he made income of 4640 and withdrew 3,000 to get us down to our new capital total. Okay, you're pretty good with the equity statement, I'm pretty sure, right, Riley? I think from what I can see on your work, I think so. Yeah, your beginning balance, which was in this case 0 plus 5, plus your income minus the withdrawals or dividends. Now that we have, see that number there, that 1640? We've just done this on paper. We have not yet moved it into the general ledger yet. And now they're showing you different forms of balance sheets. And this here is classified. They might have a true or false question. Classified balance sheet simply means we're going to classify the assets and liabilities into current assets and current liabilities. A current asset is an asset we expect to use in the next year. A current liability is a debt we expect to pay in the next year. Okay? Current assets. Current assets. Here we go. Here's Roby checking in. Hi, Roby. We'll let Roby get steady. We got Roby and Riley. Okay. Here they're talking about. Hi, Roby. Can you hear me? You're muted.
How about now? Is that better?
There you go. Thanks, Roby. Me, you, and Riley. We were just getting started in chapter 6 on the closing entries. And now we're talking about current assets. Current assets. They were talking about, here she is. Hey, Jamie. They were talking about current assets. You know something, Riley? I'm going to go back to the top, okay, Riley? This won't take too long. We'll go through this one. Okay, hi, Jamie's with us now. Roby, Riley. All right, here we go. Chapter 6 is about the closing process. We have to close the income statement. And they gave us some lessons with a worksheet, a long 10-column worksheet, which we use to prepare the financial statements. We must do the income statement first. And the income statement is done first because we got to get that into the equity statement. And I'm going to go directly to our worksheet here. Here is our final finished trial balance. At this point, we can use this to prepare the financial statements. And I was just telling Riley, go to your income line, your first revenue line, which in this case is delivery fees. Delivery fees and everything below it is the income statement. Everything above it is the balance sheet. So you're basically going to copy all of these numbers over except for one, which we'll show you in a moment. So we know that everything below drawing is your income statement. So here is our income statement. Income statement for the month ended. Don't say as of. As of would be wrong. For the month ended, or just say month of. Your delivery fee income was 8. And then they present the expenses off to the left and show a subtotal here. This can be done in different formats, okay? The equity statement. This is the statement where we bide our time. I keep saying we have a beginning balance plus the income or any investments less you're drawing to get the ending capital. So here we go. Again, they're not showing you the worksheet, but we're pulling these numbers pretty much from the worksheet. Okay? We've got a beginning balance of, I guess, 0, huh? And they put 5,000 into the business. Guy put $5,000 of his own money. Income was 4,640, but he withdrew 3,000. So this business has grown from 0 to $6,640. And then they come to the income statement, and they're talking about a classified balance sheet. This is kind of where you came in, Roby, a little moment ago. Classified balance sheet. We're talking current assets and current liabilities being separated in a subtotal. A current asset is an asset which you expect to consume or use within a year, a fiscal year, huh? A current liability is a debt that's due in a year or less, okay? Liabilities, current assets. And they're giving you some examples. Cash, current, accounts receivable. We certainly expect to collect our monies from customers within a year. We use supplies and prepaids. Those are your current assets. The operating cycle, I don't think I want to go over that. Property, plant, and equipment. These are your long-term assets, if you will. These are the ones we expect to have for a number of years. Land, building, equipment, your fixed assets. They will be around for years to come, providing us benefits. That machine we bought for $1 million last year, that's going to last 30 years pumping out our product for us. Current liabilities. Classic accounts payable, typically 30 days for the most part. Accounts payable, wages payable, you certainly don't wait a year to pay your employees. And long-term payables. A mortgage on a building would have a long-term portion to it. Or you borrowed money. You borrowed money from me. I loaned you $1 million. And the deal is you don't pay me for the next 10 years. That's a long-term payable. A note payable can be short-term or long-term, depending on when the principal is due. And they're talking the balance sheet presentation. We should know this already. Current assets are listed first because the assets in your chart of accounts are listed in the order of liquidity. So we're going to start with cash, receivables, and then the equipment, the long-term assets, the fixed assets with their related contra accounts, accumulated depreciation, short-term liabilities, and here we go. Here we go. Here's a good tip, huh? Write this down. Balance sheet must balance. Who knew, huh, Jamie? Okay. So here we go. We are looking at our finished complete worksheet here. Our finished and complete worksheet. We already did the income statement about 5 slides ago. We pulled it right from here, these numbers, which they've deliberately obscured because we've already put them into the income statement. So now we're ready to do the equity statement. And again, you had nothing to begin with. The guy put 5,000, Mitchell invested 5,000 in his business. We brought over that income, that number there, and he had some withdrawals. And that gives us, of course, our final equity, which we're now going to use to prepare the balance sheet. So the income statement goes into the income, goes into the equity statement, and we come up with our new final equity or capital. The balance sheet, therefore, is pretty easy because you're copying everything from the trial balance except one number, and that number is your new capital amount. And here it is right here. Mitchell Williams Capital, 640, whatever that number is, can't quite pick it out. That's the only thing you're not copying from here. So if you can remember that your income statement is everything below drawing, is one way to say it in this class, and everything above drawing and up is your balance sheet. The only thing that changes here is the new capital number. What do you think, Robbie? Make a little bit of sense so far?
Yeah.
Okay, all right, I'll move on. You guys jump in with questions if you can't keep up here a little bit. And now they're what are they talking about here? Balance sheet, additional investments by owners. Well, we know that the owner can always invest more money in his business. So we might have an initial investment and then a later investment. And that's what they're going to talk about here. We'll illustrate other business investments. Now we're in Ramon's shopping service. Ramon, capital account had a beginning balance of 5. Okay, that was 5,000 beginning from last month. He invested another 3. And that 8,000 balance is what he has before he starts doing any resolving of his net income. So let me keep going here. Come on, you. There we go. Oh, this thing annoys me. Okay. What they're showing you here is the equity statement. We've been over this a bunch of times. On the exam, you might get a problem where they say the ending equity was this number, and the withdrawals was this, and the income was this. What is the beginning number? Gotta be maybe perhaps work your way back. I am going to get something out to everybody before the test, which is Wednesday, on some study tips. Okay, so what they're presenting here is our equity statement, and now we have an ending balance of, it looks like $8,000 after that first investment. Okay. Now we're ready to journalize and post closing entries. Okay? Going back to here. Here is our income. Here is our income with this guy for July. They're doing 2 months. I'll pick out July. He had income in July, 2,100, and he took withdrawals out 250. So his business grew by 1,850. But you notice it is not in the general ledger yet. It's just on a piece of paper. It's just on the report. The closing journal entries, the subject of this chapter, is the mechanism for getting this income into our general ledger. We are going to close temporary accounts only. Temporary accounts. Permanent accounts go on forever, perpetuity, eternally. Yeah? Assets, liabilities, capital. In other words, your permanent accounts are the balance sheet. You don't close anything on the balance sheet with one tiny exception. Okay? You do not close the permanent accounts. You don't close the balance sheet. They continue. Cash at the end of the month was $800. At the end of the next month, it was 1,000. It goes on and on. You never zero it out. Now, here's what we're talking about with closing entries. Temporary accounts. Temporary accounts, by definition, your income statement. We are going to zero out your revenues and expenses, and then we're going to get rid of drawing, and we're just going to close that into capital. You're not going to show drawing on the financial statements. No investor wants to see what the owner's taking out of the business on the financials. So here we go. The closing process gives temporary accounts 0 balances. That sounds pretty easy. And we're going to use the income summary account. It looks like in our book here. And there's 4 steps. 4 steps. And if you can just do these 4 steps, you're a real ace, okay? Step 1, close the revenues. Close the sales accounts. Close the fees. So revenues have a credit balance, right? We are thus going to debit the revenue accounts to create a zero balance. If you had sales of $100, we're going to debit sales. And oh my goodness, those sales are gone. We're going to credit income summary to put that into our financial statements, into our general ledger. Same thing with the expenses. Expenses have a debit balance. So how do we zero them out? We do so with a credit. And now we're going to debit the account called income summary. And income summary is an account that you will never see on your financial statements. It's an account that's just used as a clearing account. In other words, we're going to take these revenues and put them in the account called income summary. We're going to put these expenses and put them in that account. And what you then have sitting in income summary is your profit, which we will then add to retained earnings. So step one, close the revenues. Step two, close the expenses. At that point, you've got your net income sitting in income summary. And hopefully, we're going to be able to debit income summary to zero that out and bring it over to owner's capital. Drawing has a debit balance. We're going to credit that. Drawing does not belong on the financial statements. You're never going to see anybody put drawing. That's the personal business of the owner. Okay? You put drawing on there, and investors go look at the company and say, well, what's this $500,000 that was taken out of business? And the owner says, well, I just put that in my pocket. That doesn't work that way. That's the owner's personal business separated. And here they're given a little bit of a, I think, a little convoluted, but let's take a look at the closing process. Here we go. Before we close, we're all done that. We've done our financial statements. We've sent statements out to the public. We in the accounting department, we took a break. Man, we did everything. Well, we just have to close. And this is the routine. We are going to see what the we're going to see what the revenues were, and we're going to debit those revenues, and we're going to credit them into income summary. We're going to get rid of the expenses with a debit, and that goes into income summary. So revenues and expenses, in other words, your profit is being credited, hopefully, into income summary. Okay? And then once you have your profit sitting here as a credit in income summary, now we're going to get rid of it with a debit and bring it up to owner's capital. Huh? A little complicated so far, Jamie? You okay? No, good. Get the friendly. No, I'm doing all right. That's good to hear. Okay.
I really like this. Figure. Actually, I used it a lot. Just going through doing the quiz and also with homework to refer back to it is very helpful.
Oh, good. I'm glad to hear it. I thought it was a little complicated myself. But good. And the drawing is going to have a debit balance, so we're going to zero that. That goes directly to owner's capital. You don't run drawing through income summary. If you did, you'd end up with the right answers, but that would not be the correct flow. So let's see what we have here. Here we go. We have a company that had income of $1,000. $1,000. Okay, here it is right here, $1,000. The revenue was $5,000. And it looks like the expenses were $4,000. That left us with income of $1,000. How do we get rid of it? We debit income summary. Goodbye income summary. This is now back to zero where we want it to be. And now we move that 1,000 into capital. So now our capital includes that month's net income. If it was a loss, it would just be the other way. Let's not look at a loss. We are glass half filled kind of people, okay? We're going to make money, okay? But if we lost money, obviously the capital would be reduced with that debit. Closing entries in the T accounts, okay? So just give me one moment here. Okay, closing entries. Here is our income statement, huh? Here are the T accounts that represent our income statement. Let me just move this out of the way here. Our revenues were $8,000. We debit revenues, in this case they call them delivery fees, and we credit income summary for 8. So at that point we have the sales recorded in income summary. Now you're going to see a number here where they debited $3,300. That's the result of crediting each and every expense. You credit each and every expense, and that becomes a debit to income summary. So what do we have now in income summary? We have the profit. We have the net profit sitting there. That net profit was $4,640. Now we're going to get rid of it in income summary with a debit and credit Mitchell Williams Capital. Any questions? Any thoughts? Comments? Shall I continue? I will continue. And this is a good thing to look at. This is what your journal entry is going to look like. Please follow the 4 steps that we were starting to talk about earlier, because it makes it so much easier. In other words, one separate journal entry for your revenue accounts. You know, you might have 3 or 4 or more revenue accounts. You might have, you know, if you're a store, you might have sales dash shoes, sales dash pants, something like that. All of your revenue accounts are going to be debited to zero them out. All of your expense accounts are going to be zeroed with a credit. The difference between your revenues and expenses is your profit, which is now sitting in the income summary account. It's sitting there, hopefully, as a credit. And now we're ready to update capital by debiting the income summary and crediting Mitchell Williams Capital. This is step 3. And then remember, drawing must be eliminated or reclassed. Let's not say eliminated. It's reclassified into capital because it reduced the capital. So now we're all set. Any questions on the journal entries? You good with the 4 steps, huh? The 4 steps. Sounds like a doo-wop group, the 4 steps. Here we go. Now that we've closed everything, our balance is 0 for all of the revenues and expenses. That's the whole point. We moved the revenues expenses at month end into the balance sheet via equity. So now we do have one little tiny job left, huh? We have to prepare what's called a post-closing trial balance. And guess what? On the post-closing trial balance, there are no revenues or expenses. It's prepared after you close. Again, all it is the list of debits and credits that equal. And the only thing left is going to be your permanent accounts. Your permanent accounts. Look at this. Capital at that theoretical point in time at the end of the fiscal month, when you've closed everything out, this is the balances in your general ledger. And where did we get these numbers? We copied all of these numbers with one exception from the trial balance, from the worksheet we did. We copied all of these numbers except for what? The capital number, which went up from 4640, whatever it was, to 6640. Okay? Closing entries. Students tend to get a little confused. They know in their heart of hearts that revenues have a credit balance, and they know in their heart of hearts that debits are the normal balance for expenses. Where you can confuse yourself is if you don't really understand what we're trying to accomplish here. What we're trying to do with the closing entries is take those revenues and expenses, or your net income, the other way to say it, and reflect what you did in the equity statement. You increased your capital with the profit, okay? Let's see what other goodies we have here. What the heck? Hold on. Post-closing trial balance, okay? The steps in the accounting cycle. Let's see what we have. I go into this. Looks like we're going back to the beginning of the world here, huh? The steps in the cycle. Well, during the month, you've gotten paperwork and emails and marching orders and texts, and you've used those to journalize, and now you prepared your general ledger account. You've posted everything. Here is what we're talking about in these last two chapters. You prepare a trial balance at the end of the month. You know that there will be adjusting entries. You know you're going to have to record the amount of supplies you used, the amount of insurance that you got the benefit of. You're going to have to record depreciation expense and the related accumulated depreciation. You're going to have to accrue some expenses, most notably wages. So you prepare those entries, and you get a new, revised, adjusted trial balance, and now you're ready to finish your worksheet. And after that, you journalize your posting entries. You post your adjusting journal entries. You're ready to prepare the statements. You're ready to close and the post-closing trial balance, huh? Statement of cash flows. Well, look at this. We're not going to go into that in this chapter. Um, other than we want to know the different types of in cash flows. Operating, that's what the business does. It's the core business. What does Microsoft need to do to manufacture software and peripheral hardware? Okay, they need to sell to customers. They need to pay people, all the basic things. Investing is purchasing a fixed asset, or you invested in another business. Financing, you borrowed money or you issued stock, huh? Maybe glance at this grid here. And I'm deliberately going a little bit quickly here. Different types of transactions. He invested money, that's financing, huh? He purchased a big piece of equipment, investing, and etc. Investing is buying a fixed asset, buying stock in another company. Here are your operatings. He bought something, or rather customers paid him for something. He paid the rent, paid the phone bill, bought supplies. The basic things a company does is operating. And we don't have to worry about the cash flows in this chapter. That's a quick look at chapter 6. What I thought I would do, unless you guys feel very comfortable, I thought I might go back to chapter 5 and go over the adjusting entries a little more. What do you think? Sound like a good idea?
Sure.
Okay. Any questions on this one? You're okay, Riley? All right. Let's go back to chapter 5. The closing process. Don't be afraid of the closing. You're closing your income statement. Uh-oh. Uh-oh. Let me see. We got it. Give me one moment here. Oh, here we go. I'm sorry, guys. I just got to move this thing here. Come on, get out of the way. Oh, for heaven's sake. Here we go. We can see the PowerPoint now?
Yep.
Okay. You should be looking at the PowerPoint. All right, we're going to go. Question? Okay. Adjusting.
I was just saying I could see it.
Can't see it?
I can. Thank you.
Okay. I appreciate the positive feedback. Thank you very much. Okay. I always look silly when I'm babbling along and nobody can see the slides. Okay. Adjusting entries. We learned in the first 4 chapters how to put our financial statements together and write journal entries and post to the general ledger. Here, we're doing our internal entries. Internal entries. Depreciation, we got to worry about. The prepaids have been used. We have employees that worked the last week of the month. So that expense belongs in that month when they worked. But we're not going to pay them for 2 more weeks, maybe 3 weeks. We have to record that expense here with an adjusting journal entries. These events have not been entered in the system, so we must prepare adjusting entries. And why? We are observing the matching principle. It matches revenues and expenses. Matching revenues and expenses, not revenues and assets or anything, revenues and expenses. Huh? Revenues are recognized when earned, has nothing to do with the cash, and revenues are earned when you deliver your product or you rendered the service. Same thing with expenses. Expenses are recognized when they're incurred, when they take place, okay? Expenses are incurred when the expenses are recorded when they're incurred. And again, what's the matching principle? Revenues and expenses. Revenues and expenses. A fiscal year could be any 12 months, doesn't have to be a calendar year. And some businesses schedule their fiscal year to end when business is slow. I think a good example of that would be like Nordstrom's, where they're super busy through December, and then they're probably busy in January with returns, and they typically close, I believe, at the end of February. General Mills, one of the stocks that I've owned for a long time, they make cereal. It's based on the farming cycle, harvest, or rather planting to harvest, okay? And here they're just going over some of the entries. You purchased $80 worth of supplies, and at the end of the month, you only had 20 left. So you use 60 of those supplies. You use 60. And if you don't record the entry, your financial statements would be wrong. You'd be recording an asset you don't have, $60, and your expenses would be understated, huh? So our journal entry is going to be a debit to supplies expense because we did use those $60, and we're going to reduce the supplies, the prepaid supplies. Take a look at the asset account now. Before we adjusted, it was 80. After we adjusted, it's now 60. Look at your supplies expense. We had 0, and the only activity we're going to show this month is that we used $60. There is your journal entry. So the prepaids shouldn't be too tough. The prepaids, it's just a matter of how much you used. Don't let them confuse you with the wording of the problem. Be careful to read it. Take time to read it once or twice extra. They purchased that one. Okay. Less 20 supplies remaining. What if they said 20 supplies consumed? Then the 20 would have been your expense. Okay. Expired insurance. Mitch paid $700 for a 10-month policy. So I guess that's $700 a month. The asset is sitting in prepaid insurance. $700, $70 a month. Adjusting entry, you debit the expense, and again, you debit the expense, $70, and now you don't have 700 anymore of that asset. You reduced it by 70, get you down to 630. So the first set of adjusting entries would be your prepaids. Assets you purchased in advance of using, okay? They're going to be expensed as you incur them. Here's the one we can all relate to. We've all been out in the workforce, but we have to understand the accounting principles here, what we're trying to do. So this company, whoever it is, so far this month, they've had salaries expense of $650. This is what they paid out. This is what they've already paid and recorded, okay? But at the end of the month, when they closed the month, there was $400 earned, probably the last week of the month, we'll assume, $400 that were earned during this same month. So that $400 becomes an expense for this month, not next month when we're going to pay it. That's what the whole idea of accruing wages is all about. You know, Roby, you worked this week and earned $400. At the end of the month, you're not going to get paid for another week or two. But the company really owes you that money at the end of the month. If you quit, they have to pay you. If they fire you, they have to pay you if they go out of business. So we have to record that legitimate expense and the resulting legitimate liability. Look at our journal entry. Debit wage expense, credit the payable. And here you see the $1,650. And I'm just going back here. This looks like a typo, huh? $1,650, but they're only showing six. That should be $1,650, okay? So take a look at your wages expense. During the month, you already recorded this month, this much in payroll expense. This would reflect the last week of the prior month plus the first 2 or 3 weeks of this month. Now we know you worked the last week and earned $400. That expense belongs here, and the offset is accrued wages payable. We'll accept wages payable. Should say accrued wages payable. Okay, it's all about the matching principle, revenues and expenses. What do we have next here? Okay, the historical cost principle. Now we're getting into our fixed assets. Assets are recorded at the original cost, and that cost remains on the books, on the general ledger, as long as the business owns the asset. No adjustments are made for any increase in the market value of an asset. And my best example would be a company bought land along the waterfront here in Santa Barbara, huh? They did that in 1960 and they paid $10,000. That land is now worth $10 million. It's still $10,000 on the balance sheet. Now, in regard to fixed assets, we have to depreciate them. We're allowed to pretend that the wear and tear on the asset is a certain amount. It does not really have anything to do with the actual value of the asset or the wear and tear. It's an accounting convention we're allowed to use. So an asset is said to have a useful life. When you purchase a fixed asset, you have to give it what's called a useful life. How long do you think it'll last? And that asset has wear and tear and starts to get outmoded. So we're going to record an expense to reflect that wear and tear on the asset in the form of depreciation expense. And we are using straight line depreciation in our book thus far. straight line. And we'll get into straight line calculation in just a moment. If you buy an asset for $50,000, you went out and you bought your sales manager a big Cadillac or something for $100,000, and you say he's going to drive this thing for 10 years, and you know you're going to beat the heck out of that car because your salesman drives all over the country, and he's kind of a crazy driver, and you're just going to beat the heck out of this. So at the end of 10 years, you're going to have to get a new car, and we're fully depreciated. We have what's called a salvage value, though, meaning at the beginning of time when we bought that car, we have to think to ourselves, what's it going to be worth in 10 years? Well, that $100,000 car, we might say it only has a scrap value of $1,000. That just means we think a drunk dealer will come in and haul it away, an auto parts store or something, okay? The point is, you do not depreciate the salvage value. So if you bought an asset for $100,000 and the salvage value was 10, you would only depreciate the 90. Salvage value or residual value, synonyms. Come on. And here we go, straight line. Straight line's pretty basic. Mitch bought motor scooters. He paid $4,800, and he thinks they're going to last 5 years. 5 years times 12 is 60 months if we want to break it into months. Okay, there's no salvage value apparently. So a month's depreciation is recognized every month. We're going to spread it over 60 months. So 4,800 divided by 60 is $80 per month. Okay, $80 per month. Now, this is the journal entry you pray is on the test because this is the easy one in that you don't have to think about what accounts. It's always going to be a debit to depreciation expense and a credit to accumulated depreciation. Okay. The difference between the original cost of the asset minus the accumulated depreciation gives you what's called net book value. Net book value, also, let's call it what it also can be called. It's also the amount you haven't depreciated yet, the undepreciated cost. Does it have to do anything with the market value? No. No, no, no. Like I said, I worked for this company for many years, most of my career with Thomas & Betts Company, and we had an old beat-up linotype machine. And that thing was fully depreciated before I was born, believe it or not. That's how old this thing was. And yet people would come in and offer us 6 figures for it because it was a collector's item. But to us, it had zero value. It was fully depreciated. Understand what accumulated depreciation is? It's a contra asset account. Contra. From the Spanish word meaning contra. Okay, the opposite. Accumulated depreciation is a contra asset, and all contra assets are married to another account. Like drawing is married to capital, accumulated depreciation is married to the fixed asset. Contra means opposite, huh? I bet you didn't know that. Has a credit balance, but it's an asset. The difference between the two will be your net book value. So what's our journal entry? It's always a debit to depreciation expense and a credit to accumulated depreciation. We will never credit the original cost of that asset. Not in this course, I don't believe, okay? What we are reducing each month is the net book value. So let's take a look here. Delivery equipment, we paid $4,800. That $4,800 is going to stay there for the next 1,000 years if the business kept going. It's not going to change. What does change, though, is the net book value. The net book value is going to be reduced $80 a month for the next 60 months. So our journal entry is going to be a debit to depreciation expense 80 and a credit to accumulated depreciation. We're never going to touch the original cost of the asset, but we're going to keep offsetting it with the accumulated depreciation. And companies love depreciation expense. The more the better. Anybody want to guess why companies love depreciation expense? You're a business person, Roby, I bet. No? Got any ideas?
Well, it makes their income look bigger.
What's that? I think you said it right. Say it again.
It makes your income look bigger.
It makes your income look, well,
it makes your income look smaller, so you pay
exactly.
less tax.
Exactly right. It reduces your income without any cash being involved. Thus, you save some taxes, right? Let's say this is a big company. Let's say that's not $80, but that's $8 million. 30% tax rate, that company saved $2.4 million in taxes. Companies love depreciation expense for that reason. That's all I'm saying. But they can't manipulate it too much. You can't buy an asset. You can't buy a car for 100,000 and say, we made too much money this year. Let's just depreciate it for 1 year. No, it has to be a reasonable amount.
Unless it's over 6,000 pounds.
6,000 what?
Pounds.
Yes, yes. I know what you're talking about. So we go along here with the chart of accounts, right? The chart of accounts. They're just showing us some new ones, I guess, huh? Accumulated depreciation, the contra. Notice how they number it. And this is pretty typical from what I've seen. Assets begin with 1, and then the contras will have a .1, 0.1, depending. Liabilities. We have a couple new expenses, insurance expense, depreciation expense. Post to the ledger. Post to the ledger. Posting adjusting entries is the same as posting anything else. No different. You might have a line here where you say adjusting, or over here where you have this reference number, you might say AJE or A for adjusting entries. And here we go. They're just showing you the different accounts. Here's the journal entry for supplies expense. You debited supplies expense and credited the prepaid supplies, and they're just showing you going into the ledger. You had a beginning balance of 0, and now it's 60, and your supplies were 80, and now they're down to 20. Same thing with the insurance expense. So on this grid here, they're showing you the prepaids. Here, they're showing you the accrual entry. The accrual entry. We worked $400 at the end of the month. We worked 40 hours that last week at $10 an hour, $400. We have to show that expense here with a debit. And here it is being brought over here. Debit being added to the $1,650 we already incurred. And the payable. We owe that money. The company owes that money at that time. Depreciation expense, always a debit to depreciation expense, always a credit to accumulated depreciation. Not too bad, Riley? Okay. Riley says I'm right with you. Okay. Let's look at the worksheet a little bit, huh? The worksheet. I love the worksheet. I remember doing this in pencil for years and years. And I never made a mistake doing it. Oh, yeah. Boy, this thing was a pain in the neck in those days. The worksheet pulls everything together and probably going to be in Excel. The worksheet is not a financial statement. It's just that. It's a piece of scrap paper to organize things. The accounting guys and women, they're the only ones who can even see this thing. And it's going to be a 10-column format. So what are our steps here? We prepare the trial balance. We know that already. We adjust the trial balance. We get a new and improved adjusted trial balance. And then we're able to prepare the income statement and balance sheet columns. Worksheet, you put a heading on it. Step 1, prepare the trial balance, your first 2 columns in this thing. And I have a pretty good picture of one here. I'll show us in a moment. The first two columns are going to be your trial balance. The next two columns, you record the adjustments. I'm going quickly for a reason I hope you'll see in a moment. So we started off with the trial balance columns, debit and credit. We write the adjusting journal entries in the next two columns, debit and credit. And now we bring over the adjusted trial balance, okay? The adjusted trial balance. So cash, beginning was a debit. You're never going to adjust cash, right? You're never going to, it's not like supplies. You go into the supplies room and you come out and you say, boss, we use $60 worth of supplies. You don't walk into the safe and come out and say, boss, we're supposed to have $4,000 there, but there's only 3,600. And the boss says, okay, that's just adjusted. No, cash does not get adjusted. You prepare the adjusted trial balance, and this is pretty easy. Let's find one we're working with. We had a debit balance in supplies, and we credited supplies by 60, which leaves us with the balance of 20. We had supplies expense down here of 0, which makes sense because we can't record supplies expense until the end of the month. We debited supplies expense 0 plus that is that. Let's take a look at the depreciation expense, which I hope is here. Depreciation expense, where'd that go? Uh-oh, they don't have, oh here, depreciation expense right here. Apparently they didn't have any equipment, this company. They didn't own anything. So they went out and they bought that piece of equipment. Where is it here? Where is our equipment? I can't even see. Delivery equipment, 4,800, right? We're never going to change that. So we just bring the 4,800 over. But we know that the depreciation is $80 a month. So here's where we're showing the journal entry. Debit depreciation expense 80. Credit accumulated depreciation 80. So we had 0 to begin with, and now it's a credit balance. In other words, to get to the adjustment here, it's simply debit, credit, debit, credit, whatever it takes to come across here. Not too tough, I don't think. This is the hard part right here, doing the journal entries, making sure you're recording this information correctly, okay? Once you get this portion of the worksheet complete, the adjusting trial balance, these two guys are easier than falling out of a chair because you can now copy just about everything over. Come on. Extend the adjusted balances to the income statement. Yeah, that's where we're going now. Extend the, when we get the, what they're saying here is when we get these two columns done, we can now do the income statement and balance sheet columns. So let's see if they give us a little demonstration. And here they're talking about ruling, and they're giving us some other rules that I think are better for me to just point out to us, okay? Okay, so let's assume we have now prepared all the necessary adjusting entries and our trial balance is fully adjusted. Now we can do the income statement, which must be done first. And what is the Bob Smagula rule here? Everything after your drawing, starting with your first revenue, is your income statement. So income statement, let's see, income statement was $8,000, please excuse me, $8,000, and you had these various expenses. We add them down. Guess what? This column is out of balance now. You see that? It's out of balance. But we want it to be out of balance because we want to see more on the sales side, more on the credit side. So at this point, we have made a profit of this minus this equals 4,640. We're good with the profit calculation, I'm pretty sure, huh? Now we just have to balance these two columns. We are going to take that profit and add it or debit it here so that these two columns now balance. And if it's a debit here on the income statement, It has to be a credit here on the balance sheet because that's going to add up going into your equity. So that's a quick look. Let me see something. Okay. All right. We'll keep going here. They talk about different methods for finding errors. I am not going to go into this too much. Finding errors. Guess what they're telling you? Check, check, check. You double check. And there's some little tricks here that you might find interesting. Journal, boy, this thing jumps around, huh? Finding errors. Then we're back into journalizing, adjusting entries. We're back on the worksheet, huh? All they're doing here is showing you the journal entries and how they are written in here. These are your journal entries in the general ledger, and this is where you posted them on the worksheet. These two columns, plus and minus this, gives you the next two columns. We are not going to talk about cash basis or modified. Everything we do in the world is accrual accounting. Nobody uses cash accounting except maybe small businesses who don't care about borrowing money or even preparing financial statements. My dear brother-in-law back in New Jersey, my sister's husband, he didn't even graduate high school. He's not a stupid person, don't get me wrong, but he worked in the family business for years and years. They had auto parts stores and they had pizzerias and stuff. And I used to say to him, Marty, I said, how do you pay yourself? And basically, they would just empty the cash register at the end of the week. It was that simple a business. So they were super cash basis, and didn't care about this. But for the most part, that's a fantasy world. Okay. Accruals, revenues recorded when incurred. Same thing with expenses. We're doing the matching principle. Cash versus accrual. I am not going to go over these items, okay? If you get a test, and again, I'm not making up these tests. These are coming from the system. If I see questions on modified cash basis or something, I'm going to ignore them. They will not drag you down, okay? And I don't think we need to go into the different depreciation methods. Different depreciation methods. Straight line is the one we just used. There are others. When you get into accounting 230, you'll find a lot of others. And I think we're getting to the end here. They're just going over another example of straight line. Here, they bought a van for 40, salvage value 4,000. In 5 years, we think the junkyard guy is going to come down and haul off the parts. So we're only going to depreciate the 36,000, only 36,000 over 5 years, 7,200 a year or 600 a month. Straight line, pretty easy, huh? Straight line.
I'm going to have to leave you right now.
What's that?
I'm going to have to leave you right now. I've got another commitment coming up.
All right, Roby, good to see you. And we're just finishing up here, so you take off, pal, and we'll see you later on, okay?
Okay, thanks.
Bye-bye.
Bye.
Straight line. 1/5, right? 1/5 is 20%. We know that. Here's an interesting little thing real quick. The depreciation schedule. You had a machine you paid $36,000 for, and you had salvage. You paid 40, and you deducted the salvage to get the 36. So every period, it's 1/5, 7,200, or 20%, 72. Look at your accumulated depreciation. At the end of the first year, it's this. It goes up by 72. And the book value eventually comes down to the salvage value. And I think we are done here. Looks like it's just me and you, Riley, huh? We chased everybody away. Oh, there's Jamie. Jamie's, you've come back. Okay.
I've been eating, so I turn off my video when I'm eating.
I always think people have just ducked out. Okay, so that's a little bit of, not a little bit, I think a pretty good review on chapters 4 and 5. I just want to keep you here for just one other thing, if I may. Let me move this out of the way. Jesus. Come on. You can see this Excel worksheet.
Yep.
Here we go. This is our worksheet, and I'm just going to drop a number in here. You know, we come on. What happened to our worksheet? Hold on here. Here's our worksheet. I'm just going to just go over one thing real. Boy, some spelling errors in this thing, huh? Okay. Accumulated depreciation. Let's assume we had 6,000 here. Credit accumulated depreciation. And I would hope to see depreciation expense down here somewhere. So we debit depreciation expense. And all we do is take this plus this to get our 6,000 here. And over here, we had set, this is what I want to show you. We had 72,000 credit. Now we have 6. So what number goes over here?
$66,000.
Oh, I knew somebody was going to make that mistake. Okay. No. What was the balance here? 72, right? Credit. This is another credit. This is 78.
Oh, 70.
Aha! I knew I was going to trap somebody.
Good job.
Yeah, see, just I mean, that's an easy slip up to make. I mean, everybody does that. You know, everybody falls into that trap, I think. So the whole point is, and now you bring these numbers over to your income statement. Everything above, this is actually from 230, but everything above your sales line here is in, this is balance sheet, this is income statement. Okay. What do you think, Riley? Was that enough for one session?
Yeah, that was good.
Okay, you don't want to spend any more time here than we have to, right? Okay. You good, Jamie?
Yep. Perfect. Thank you.
Okay. Yeah, I went over, I caught up on all the corrections yesterday. I normally do them late. I find doing them Sunday night works good for me after a day of, you know, watching my sports or whatever. And there was a question on the quiz where they asked for a couple journal entries, and most of the class did not do it at all correctly. And I copied a comment down for all of you. If you look at the chapter whatever it was, quiz, chapter 4 quiz. There was a question the class just didn't do well on. So I just wanted to bring that to everybody's attention. Okay. All right. I guess we're ready for our test on Wednesday.
Mm-hmm.
Okay. You all know where to find me, right? I'm not hiding.
Yes, thank you.
Hey, bye-bye, everybody.